We're seeing red across the board in the equity markets on this Tuesday afternoon. We got mixed economic data releases, and we're keeping an eye on oil prices. So joining me to weigh in on all this action is Stephen Guilfoyle of Deep Value Executions. Sarge, thanks so much for joining me today.
Oh, thank you so much for having me today.
Well, we're seeing a reversal of yesterday's trading action. The Dow is giving up most of its gains in afternoon trade. But given that we're seeing this oil as well as equity market correlation, what do you make of today's action?
Yeah, the Saudi oil minister came out and he made sure that we all understood that there's a big difference between an oil freeze, a production freeze, and a production cut. And they're not really all that interested in a production cut. All right, so a lot of the guys that were jumping on the oil bandwagon started jumping off. We got some lousy macro today. We saw consumer confidence really went into the skids a little bit. Yesterday we saw the market manufacturing flash come out on the weak side. We got a nice number for existing home sales, but that didn't seem to help all that much. And so we kind of went into a risk-off mode. We got let's call it the four horsemen of the safety dance. Right? Gold, utilities, and the VIX. Those are your four horsemen of the safety dance, and they all moved together. You actually saw within about 10 seconds the Treasury market. You saw it go from negative to positive, and that was your big indication that people were going to start moving out of risk today.
And Sarge, unfortunately, we have limited time, so we can't cover everything. But I think we should talk about interest rates. Since we last spoke, we've been getting some negative interest rates, and here in the U.S., we'll be getting Fed speeches this week. But overall, what do you make of what we're seeing globally?
I don't think negative interest rates are really positive for anybody. It's not working in Japan. It's not working in Europe. Whenever it's mentioned here, the whole financial sector takes a hit. And you're seeing what's happening to the banks in those areas, too. So I think while the Fed may be slow to raise rates, I'm pretty sure they won't be doing anything in March. I think they probably do want to get another interest rate hike in this year. I don't think we're out of the woods as far as that's concerned. I think they will go to great lengths to avoid that in this country, going into a negative rate, And
Stephen, before I let you go, this isn't a trick question at all, but since we talked about the correlation between oil and stocks, given what we're seeing in terms of selling from these sovereign wealth funds, how closely should we be tracking selling from those funds?
Oh, very closely. I think that's really what we saw that key day about a week and a half ago where the S&P 500 bounced off 1810. That was a key component there. Sovereign wealth funds selling. And while we have been correlating on and off with oil, it's not a strict correlation. But only the energy sector and the transports are really that tightly correlated with oil, in my opinion. Everything else just kind of gets pulled along with the momentum. I don't think there's a strict correlation there. And I think you can probably pay less attention to oil if that's what you're trading. But the sovereign wealth funds, that is an issue.
Well, Stephen, thank you so much for letting me pick your brain today. And thanks, as always, for all your insight.
Oh, you're welcome.